Economics is the study of how society allocate scarce resources among competing demands. It seeks to explain how individual business and governments take decisions about what to produce, how to produce it, and for whom it to produce it. Economics is divided into two main branches: microeconomics and macroeconomics is the study of individual economic behavior such as how consumers make purchasing decisions, how firms set prices, and how market function. Mi- Microeconomics, on the other hand, is the study of economy as a whole, including issues such as economic growth, inflation, and unemployment. Finance, on the other hand, is considered with the management of money and other assets. It deals with issues such as investing, borrowing, lending, and risk management. Finance is also divided into two main branches: corporate finance and personal finance. Corporate finance is the study of how firms raise and manage capital to finance their operation and growth. It includes topics such as financial analysis, capital budgeting, corporate governance. Personal finance, on the other hand, is the study of how individuals manage their personal finance, including budgeting, saving, investing, and retirement planning. Two field of economics and finance are closely related. Economic principles underline many financial decisions, and financial decisions can have significant economic impact. For example, interest rates, which are a key aspect of finance, can affect economic growth and inflation. In general, economic policy can have significant impact on financial markets and investment. Finance is the study of how individual business and government manage their money and investment. It involves analyzing financial statement, evaluating investment opportunity, and making decisions about how to allocate resources. Finance is divided into several sub-disciplines, include corporate finance, personal finance, and public finance. Corporate finance is considered with how business manage their financial resources, such as raising capital, managing debt, and making investment decisions. This involves analyzing financial statement and financial ratio to determine a company financial health and infinity area for improvement. Personal finance is focused on how individuals manage their personal finance, such as budgeting, saving, investing, and managing debt. It involves making decisions about how to allocate resources to achieve personal finance goals such as retirement or education. Personal public finance is considered with how government manage their financial resources, such as raising revenue through taxes, managing government spending. This involves making decisions about how to allocate resources to achieve public policy goals such as economic growth or social welfare. Economic is the study of how individual business and society allocate scarce resources to satisfy their unlimited wants and needs. It involves analyzing how markets works, understanding economic policies, and making decisions about how to allocate resources to achieve economic goals. Economics is divided into several sub-disciplines, including microeconomics, macroeconomics, and international economics. Microeconomics is considered with how individuals and firms make decisions about production, consumption, and pricing in market economic. This involves analyzing the behavior of individual consumer and producer as well as interaction between them. Macroeconomics is considered with how the overall economy function, including issues such as economic growth, inflation, and unemployment. It involves analyzing the behavior of the economy as a whole, including action of government and central banks. International economic is focused on how countries interact with each other through trade, investment, and financial flow. It involves analyzing the effect of international trade policies and exchange rate on the global economy. In both finance and economics, there are several key concepts and principles that are commonly studied and applied. These include time value of money, the idea that a dollar received today is worth more than a dollar received in the future due to potential for earning interest or other returns. Risk and return, the idea that higher returns are generally associated with higher level of risk and that investor must be compensated for taking on risk. Supply and demand, the idea that the Price of good or service is determined by the interaction between buyers and seller in a market. Opportunity cost, the idea that the cost of decisioning the value of the next best alternative that must be foregone. Comparative advantage, the idea that individual business and countries should specialize in producing goods and services in which they have a lower opportunity cost and trade with others to increase their overall consumption. Monetary policy, the action taken by central banks to control the money supply, interest rates to achieve macroeconomic goal. Fiscal policy, the action taken by government to adjust tax rates and government spending to achieve macroeconomic goals.